Kate Warren, before we talk about individual stocks, what's your view of the market overall in 2013? What are you expecting?
Well, we think that we're going to continue to see some of the same fog of uncertainty that we've seen this year, with a lot of policy uncertainty, a lot of global economic uncertainty. But the good news is some of those things should begin to be resolved, and that tends to be a positive catalyst for the markets. If the economy just continues to grow at around 2%, which is what it's been doing, earnings continue to rise at something in the mid-single digits, that's actually a pretty positive outlook, even though it seems that everybody's just focused on all the uncertainty.
Well, there's still a lot of regulatory uncertainty around the exchanges. Yet one stock you like is the CME Group. Tell me why you like that one.
Well, we like that largely because it's going to benefit as more and more trading needs to move to exchanges. We see that as an opportunity for them. We also like the fact that they have a dividend, and we expect the dividend to grow over time.
You're also a fan of Qualcomm. Clearly, everything is moving to chips and tablets and smartphones. Why are they positioned well for this trend?
Well, basically, if you buy any kind of smartphone, some royalty is going to Qualcomm. So because they've got the patents in many of the areas, we basically see them as a beneficiary of the entire demand growth for moving to smartphones. And it doesn't matter which brand you buy, you're supporting Qualcomm.
You're also a fan of Heinz. Tell me why.
Well, we like Heinz because they're, of course, taking ketchup, which goes on everything. We think the demand is
rightfully
growing for that.
so.
Exactly. They've got new packaging, but they're also moving into emerging markets. We see that as a real growth area for them. And again, a stock that has a tradition of dividend growth.
One final stock that you like is Phillips 66. Now, America needs more refining capacity. We saw that during Sandy. Why do you think Phillips 66 is the answer?
Well, all of these companies either have new products, new ways of doing business, or new strategies. And clearly, Phillips 66, having been split off from its parent ConocoPhillips, is a sole focus on refining. Right now, it's got an advantage in that in the Midwest, its cost of oil is a lot cheaper than here on the East Coast. But the prices everyone pays for gasoline are about the same across the country. So what they've got is a cost advantage, and we see this new strategy as something that can help them grow over time.